May I have your attention? Please welcome to the stage, Matthew Panzarino.
Hello, welcome everyone. It is wonderful to see you here this morning at our brand new expanded kind of festival-like atmosphere we have here at Disrupt. Welcome to the FinTech stage. We have a wonderful day of programming for you, everything from consumer to SaaS and everything in between, solutions, problems, problems that need solutions. We've got it all. We're happy to have such a stacked set of panelists and moderators who have been preparing this for you all year long. It takes us a very long time to put it together, so we're gratified that you showed up for us, and we're happy to have you here. Remember that later on, we also have a meetup after the event at 5 p.m. at House of Shields. So that's our FinTech meetup for today, so feel free to join us for a little beverage and a little bit more discussion about the world of FinTech. So thank you very much, and enjoy the show.
May I have your attention? Please welcome TechCrunch Plus Managing Editor, Corinne Levy.
Hi, everybody. Thank you so much, and thank you to Matthew. My name is Corinne Levy, and I'm the managing editor at TechCrunch Plus. That's our subscription side of the house. So that means that anytime you're reading a TechCrunch article and you hit a paywall, that's me. So you can DM me if that annoys you, and I'll tell you to sign up for a subscription. So I've been doing tech journalism for a really long time, like 20 years. And this is my first time at Disrupt. So I'm very excited to be here. It's crazy. It's crazy that they just let me up here to host this, being here for my first time. So this is going to be a very exciting stage today. It's been a really wild year for FinTech. You know, we've been freaking out about a recession. Banks collapsed earlier this year. Crypto is just going down all of a sudden. And it feels like the world of FinTech is changing, and it's being rewritten as we speak. So how do we navigate that? Today, you'll hear from a bunch of people who will explain that all to you. For example, we have Zach Parrott from Plaid, who will talk about open banking. We also have Ariana Simpson from A16Z, who will tell us about why she's still betting on Web3 and dumping crazy money into the space. And we'll also have Silicon Valley Bank President Mark Cadger, who will tell us all about what went down back in March. And please remember that you don't have to take notes. We have Otter here that's transcribing everything for you all day. There's QR codes that you might have noticed that will help you get started with Otter. And as you're wandering around, those of you with a founder or an investor badge can check out the Deal Flow Cafe, where you can make some deals, hopefully. But remember that you need to have an investor or founder badge. So, creating a bank was supposed to be super easy, right? Or sorry, creating a bank account, not building a bank. Creating a bank account is supposed to be really easy, as is storing money, getting a payment card. It should all be as easy as signing up for LinkedIn, of course. It's not quite there yet, but that's what embedded finance is supposed to promise to do. And there's a new wave of companies that are reinventing the space to make any company a FinTech company. Today we have Peter Hazelhurst from Synctera. We'll have Laura Speakerman from Alloy and Amanda Swarverlin from Unit. And we will be moderated by my colleague, Roman Delet. Please welcome them all to the stage.
Hello, everyone, and thank you for being here for the first panel of the day. I'm sure you had to wake up very early. Very excited to be here with you three. We're going to talk about embedded finance, banking as a service, some very technical terms. So maybe I'm going to start by making it a bit more understandable for everyone. So I want to play a role-playing game. I'm Roman. I'm a tech entrepreneur creating my company. And this is, I don't know, an e-commerce business, for instance. And I want to offer financial services to my own customers. And I'm thinking about using a banking as a service company to help me in this endeavor. So maybe I'm going to ask Amanda first. How can I use a product like Unit for this endeavor?
Yeah, so for Unit, we are an infrastructure company that really helps a company, like you described, partner with a bank to embed a financial product into whatever software it is that you use. And as building a bank, as we mentioned, not easy, and it's very complex. There's a lot of regulatory rules and different things that go around that. So really, our job is to help simplify that for both our clients and our bank partners by providing that infrastructure. We firmly believe that each party does what it does best. So you, as a business owner, you can build a really amazing product and a really amazing user experience. The banks are really good at compliance, payments, moving money, and we're the technology that can help facilitate that and make it simple to be able to partner with that bank and to make the technology pain a little bit less in that ecosystem.
So in that way, I don't have to talk with any financial institution myself. I just talk to Unit.
In our model, you actually do talk to the bank. We do actually think that it's important for the clients to get to know their bank partners and for the bank partners to get to know their clients and have that relationship and that oversight over the product. But we make that process more seamless and we make it easy to make that connection and to facilitate those conversations. But in our model, there is that direct relationship.
And Peter, at Synctera, you talk a lot about your work with community banks and different financial institutions. Is it important as well to mention all the partner banks that you have working with you for your
yeah, look, I think
as a service
if
product?
you're a founder and you came to us and said, I don't want to meet my bank partner, we'd say, go find someone else to work with. It's really, really imperative that both the banks and the tech companies...
But is it the case for some banking as a service companies? They say you don't have...
Some banking as a service companies don't let you meet the bank, which is a very weird dynamic for us. And
you have names?
I do, but I'm not telling them. But no, I think it's really important to distinguish between partnership and relationship building between the three parties that are involved and just a service provider relationship. And we believe in building a partnership and helping the bankers and the fintech companies get to know each other.
Interesting. So Laura, you work for Alloy. You focus more on risk management.
Yeah.
And you work with other financial companies trying to assess their risk. Do you work with fintech companies like Synctera or Unit, or more with traditional banks or new banks?
Yeah, all of the above. So Alloy works with over 500 clients, and those would include fintech companies, non-fintech companies, banking as a service providers, embedded fintech companies, and then a lot of banks too, sort of across the whole supply chain to help them solve their identity risk problems. So they have all sorts of identity challenges from compliance, KYC, AML, to fraud and everything in between, and we help them manage those problems. And so we embed ourselves wherever we need to be embedded. We often view ourselves as like a little bit of a translation layer, whether that's sitting between the fintech company and the regulatory agency, or the partner bank and the fintech company, or the embedded platform. So we can kind of fit ourselves in wherever, but we think of ourselves as sort of the engine that makes all this identity stuff a little less painful.
And how does it work, like in the infrastructure stack? Do you actually embed with these clients like on site, or do they make calls to you?
They make calls to our API, yeah. Make calls to our API that says, is this applicant legit in all sorts of ways? Are they laundering money? Are they likely to be fraudulent? And we do a bunch of magic on the back end, magic that we expose to you so you can have a paper trail and understand exactly how we made our decision. It's not a black box, but we return in real time something that says, here's what we found, here were your rules, here's how you said you wanted to make this decision, you wanted to be able to match their address, you wanted to make sure they weren't on a watch list of some kind. Here's the response, yes, go ahead and open that account or let that transaction happen.
Interesting. I want to give one more example about embedded finance with you, Peter.
Yeah.
Because I think before Synctera you worked for Uber, that's right?
I did, yeah.
Yeah, on Uber Money. And can you tell us a bit about this project and how it actually worked And,
Yeah, so I mean, the learning we had at Uber was we had to have drivers having bank accounts. And in many of our markets, drivers were unbanked or completely never been banked at all. And what we used to do was have the local city manager do a deal with the branch manager of a bank downstairs in the same office tower. And they'd say, show the app, walk downstairs, and you'll get a bank account. And that was bringing people into the banking system. What we thought we could do, which would be much more advantageous to everybody, was put the banking enrollment experience into the Uber app, and we called that Uber Money. And we created bank accounts that were fee-free, really optimized for the driver's behavior and what they needed, including $100 overdraft if they needed to get gas in the morning. And what this did was it created a much extended ecosystem. So we spent a lot of time optimizing payments for riders. Most of you have probably experienced the Uber experience of just walking in, getting out. If you're in the rest of the world, you pay in cash. And so the cash use case was solved when we introduced Uber Cash and the concept of a wallet in the Uber app. Now toss that on to how do you pay the drivers. And if you have 3 million, 5 million drivers, you need to get money in their hands. What we did with Uber Money is we compressed time. We used to pay drivers once a week with ACH. We then introduced daily pay with 25-cent payments. We introduced same-day payments so that people could push money to their debit card. Massive business and massive opportunity. But the real answer was pay them in real time. And so with Uber Money, we made it possible the moment your trip ended, the money gets deposited in your bank account. And that created a much stickier relationship with our driver community and is the classic definition of embedded finance.
And at Unit, for instance, how do you pitch embedded finance to potential clients? Do you say this is a new revenue stream, or is it a way to keep customers engaged, like in Uber Money's case?
So it's really both. It's actually quite amazing, the variety of use cases that we see across the ecosystem. It can be trucking companies that want to pay their carriers or warehouse and make sure that there's more real-time payments with that. Or it can just be the fact that there's more data analytics, right? It can be a software company for small businesses or payroll that want to help that end user, that business that they're already helping with one thing. They have all this data that can give them financial insights, right? And so now that business owner can start making better decisions on their finances in addition to the help they're already getting from that software company. So it's a really powerful tool that then makes that customer stickier, but then also can do things like same-day payments, right? And because it's all kind of in the same ecosystem, there's more features that are there. Again, making it stickier. And then, of course, there is the revenue stream piece of it. So I think we see a lot of clients who come to us really looking for both the revenue and the stickiness factor that comes along with it. And there's many companies just across so many different verticals that have been really successful in doing that.
And among the feature lists that Peter listed, do you offer the same kind of features at Unit?
Yep.
Like same-day payments and things like that?
Yeah. Yep.
Oh, interesting. And I want to talk more about risk, and especially who carries the risk in this equation of embedded finance and banking as a service. Maybe Laura, you can answer this one as the risk expert here. When you work with an embedded finance company, who assumes the risk? Is it like the company, the client, or the embedded finance company?
So there's different kinds of risk, right? Like you can talk about everything from reputational risk to go to jail, you violated some serious, laws risk. Amanda's better to opine on the latter. But there's a lot of different places where you can introduce risk. And so if you are a fintech company, you certainly carry some risk and you are regulated. You are generally more regulated if you're the partner bank, and that's where a lot of the true sort of burden lies. And that's part of the challenge is the partner bank isn't doing the customer acquisition. They need access to the customer data, though. They need to be able to see sort of who are we bringing in and giving them bank accounts. We're on the hook for that. We're being, you might have the OCC or FDIC or whoever who's sort of looking over you, but these aren't sort of they are your customers, but you're not bringing them in. The fintech company is, and so a lot of the risk management lies in making sure that people are on the same page about the policies. And then there's fraud, so different type of risk, where generally The fintech companies, and again, correct me if you guys have seen other models, but generally the fintech companies are on the hook, less so the partner banks.
Yeah, we see the same. So
yeah.
fraud risk, the actual financial losses, is typically borne by the fintech themselves.
Yeah.
But the KYC and compliance risk is a bank's responsibility that they can't delegate. They can ask people to participate in the process. But they can't just sort of say, hey, I don't care who the customers are.
Yeah.
And so it's like a range of different levels of oversight. And ultimately, the bank is responsible to make sure that they're banking legitimate people in the US or in Canada or wherever they're operating.
And do you have rates that you track, like how many fraudulent transactions are going through our services at Unit or Synctera, for instance?
For sure. I mean, there are some absolute rates. So the Fed will say, if you do too many bad ACHs on the network, then you run the risk of the bank getting shut down from connectivity to the Fed. So those are the upper bounds that no one ever wants to get anywhere near. And then there is, is the customer viable from a financial performance perspective? So if they're losing tons of money every day from fraud, then is the fintech actually viable anymore?
There's also this changing market dynamic, I think, where you're starting to see more potential regulatory oversight of fraud. You see folks like Elizabeth Warren talking about some of it, Zelle scams, right? This is like very much in the news, where I think we're all trying to figure out, at least the United States, I think Europe is further ahead. They've sort of, UK especially, has decided to regulate a lot of this. But in the US, we're still figuring out what is our view on sort of who bears this burden of fraud, and do we think we should regulate it? I think we're trending towards yes. I mean, probably in a very long cycle, but certainly more than we were 2 or 3 years ago, where it was sort of like fraud's just, you got to do it. And then I think the other thing we're seeing is that in a challenging fintech environment, which we're in, unit economics matter. Fraud 2 years ago was sort of cost of doing business. Now I think it's eating into your margins. It's a real cost. We did a survey recently where 93% of, I think it was a majority of fintech companies had seen huge losses, like over $250,000 of losses. And it's again, maybe a few years ago when VC money was free and floating around at this conference, you now have to care a lot more about that $500,000.
I think there's a lot of good news that can come from what we're learning today, though, in terms of this, and in where a company like Unit can help give insights into that, because we have such a broad perspective on what we're seeing. And so in embedded finance versus a company that maybe is a pure financial play, right, where banking product is all that they offer and it's kind of open to be able to do that, we know the levers, right, that a company with embedded finance can start to dial up or dial down to be able to say, okay, there's a paywall, or there's another...
You have a captive audience, sort of.
You have a captive audience, right? And so they have to sign up for another service before they get access to a financial product. And then we know more, right, in between the client and the bank about that particular user base. So we can say, maybe these are the limits we should offer. Maybe these are the features. And maybe once we know we have a history with them, we can start to offer them ACH debit, right, to be able to do that. And so I think that the ability for us to take the learnings from this and actually productize that and put that into our products to offer that to other clients that come on board is a really powerful tool, and actually should help reduce fraud over time by being able to do that. So as long as we keep learning from that and productize, I think the future is really exciting.
And in your role at Unit, you talk a lot with banks in particular. Do you have difficult conversations with them saying, okay, you're sending us too many bad clients, we don't want to work with Unit anymore, we're cutting you off?
No, I mean, we have our own internal standards before we even, like, as we go through and we talk to people. A lot of our sales team is here this week, and we have our internal processes that we do, but then we listen to the banks and we say, what's your risk appetite? What kind of clients do you want us to bring you? Where should we be looking? And when we find those, we introduce the client and the bank, and they have a conversation about that and decide if they want to move to full due diligence and go through the process of that. So it's actually a really easy way to manage what that deal flow looks like, and the banks are in complete control of that.
And you at Synctera, what kind of relationship do you have with banks? Is it always positive?
I think so. We just signed a new one today, Stearns Bank, and they seem lovely. But I would say, like in general, the way our approach works is somewhat similar to Unit in that what we do is we do a whole bunch of homework ourselves on our potential customers and understand who they are and what they do and what the risk they're taking and the economics of the deal. And then we send out a note to our sponsor banks saying, here comes this amazing deal, are you interested? So we let them opt into being part of the process of learning more. Then we introduce the fintech to 2 or 3 banks and say, which one do you like the most? Because there's always going to be some sort of prioritization or perspective that you get from both sides. Ideally, the fintech says they like 2 or 3, so then we can help load balance so no bank gets too many customers at any one time. And then we go through the final stage.
Each customer only has one banking partner, right?
Usually they start with one. Post SVB, most of our larger customers have come to us and said, can you give us 2 or 3?
Each end customer, I think, would only
yeah.
have one.
Yeah, each end customer.
Right.
Oh, each human?
No, each
is banked by one.
Each of your clients.
Oh, fintech.
Each one of our fintechs could have 2 or 3 banks under the covers.
Okay.
And they've all become more thoughtful about that, given the risks that they have if all of their eggs are in one basket.
Is it more complicated for you, like in the back end?
No, for us, it's just give them a second API key. It's really simple. And we have a whole bunch of analytics that sit sort of cross-programmed so that the fintech can see what's happening across multiple bank domains, if you will.
So fintech is sort of evolving in this sort of layered approach. There are companies, there are embedded finance companies, there are banks behind the scenes. And with Alloy, for instance, are you another brick, and do you think there are going to be more fintech bricks contributing to this fintech?
Yeah, I go back and forth. I think there will be more bricks, and I think that's been a really good thing for the industry to give redundancy, right? When there's one problem with some bank or some vendor, you have the ability to quickly switch. You don't want to shut everyone's bank accounts overnight. You're messing with people's money. You want to be able to make sure there's sort of resiliency in the infrastructure. And so the competition in the market and the number of vendors has been really positive. On the other hand, the more layers you have or vendors you have, the more important it is that we be able to sort of work with each other and talk to each other. Like I have to be able to make sure that you, Amanda, have access to all this data about the customers that you can then share or share in certain parts with your partner bank and maybe with the regulator and with the fintech company. And so those translation layers have to exist both from a policies perspective, like let's make sure we're all on the same page about who we're giving bank accounts to, but also from sort of like a technology perspective, how can you make that process as close to instant as possible when we're sort of calling each other and going like, hey, can I let this customer in? You know, so I think that's the challenge for the industry. So I don't know, I think there will be more bricks, but we're also in this weird moment of like consolidation in the fintech market because everything's sort of been
exactly. You talked about the tough environment right now. And if you add more companies in the process, does it mean like there are less margins as well for everyone?
Yes. The unit economics, when you add in all these layers, it does get constrained. However, in a world without like these two, this doesn't exist because the banks weren't doing this themselves before. They weren't building digital banks for the LGBTQ community. It just wasn't happening. So,
I think the hard part is if you're a company, big or small, and you want to do banking as a service, and you say, I'm going to go do it by myself, you're spending 6 to 9 months, if not more, on BD and legal, just doing contracts with every vendor in the ecosystem. And you'll start with $100,000 a month in minimums, because every one of these vendors is going to say, I'm $5,000, I'm $10,000.
You also have to be a compliance expert.
And then you have to become a compliance person, then you have to do legal, then you have to do onboarding, and then you start coding. And then after that, you say, hey, I built all this stuff, can I find a bank? And the problem is the banks are all sold out. So you get finished, and the banks say, well, that's awesome, but I'm going to go work with this company over here that's already on my platform and has $250 million in funding. So the value that companies like Synctera and Unit bring is all of that stuff, all of that integration work, all of that partnering, it comes with one single deal, one agreement between us and you. And we bring you a marketplace of banks that you can work with, which have different risk appetites.
It's a much easier relationship. At Unit, who is your biggest client, for instance?
Well, we have a number of different clients across.
One of them, let's say a handful of them.
Honeybook is a great client of ours. Relay Financial. I could continue on with a listing of those. And so those are two examples of.
And when they grow, at some point, do they come to you and say, we want to build a team internally and start our own fintech stack and leave you?
No, we get that question a lot about if banks want to go quote unquote, or if clients want to go quote unquote direct. But really, when you
rogue.
but when you think about it, we actually are direct, right? In our models, like our clients do get to talk to the banks, and they get to have that. So we don't hear that conversation because again, in the model that we have, we're really just trying to allow everybody to do what they do best. In that ecosystem and provide those lanes for that piece of it. So it's not something that we've seen to date.
There's also, I think, like this, we've seen this on our end too, where folks think that, they might come into this going like, yeah, I'm going to use it for 2 years and then I'm going to move off of it. People don't, because they realize how much of a pain this is to build at sort of every layer and how much they're going to spend. If they do any sort of math, it becomes really crazy. So they get into it thinking, all right, I'm going to abstract away, but they don't typically do it.
I think it kind of depends on what their core business is. If their core business is also being a fintech to their ecosystem, think a payments company or a Toast or someone like that, you might argue that they have people in-house that are doing many of these functions, and at some point they could say, hey, I'm going to build that myself. At Uber, we had a really large team on the payments corporation because we were doing payments in 70 countries in every different possible way and form. And so it was relatively straightforward, notwithstanding budget constraints, to carve off a team to say, hey, we can go launch a neobank for our driver community. And we had all those relationships. So we had relationships with MasterCard and Unit and everybody else under the covers. So as we then went forward, we were in a unique proposition. Spinning up Synctera was basically a reflection of, not everyone has hundreds of engineers working on payments. How can I commoditize all of that functionality so you can focus on your business? Be a payments company if you want to, but in reality, most of our customers today come to us from different use cases that aren't with their own engineering teams and product teams focused on payments themselves.
Interesting. And I'm sure we have many entrepreneurs in the audience. Maybe one last question. What sort of advice would you give them to get started with embedded finance? If they want to offer financial services, should they go to Synctera's or Unit's website?
Definitely sign up. My email's p@synctera.com. Hit me up. But no, look, I think the biggest advice I would give you is don't underestimate the compliance and the focus on getting it right from the start. It's really, really easy to go down a bad path and make your KYC funnel really sloppy and then run the risk of getting the regulators all over you. Be straightforward, be transparent with your customers on who you want, and make it really easy for them to onboard, but don't cut any corners.
All right. Thank you very much, everyone, and have a good Disrupt.
Thank you.